Welcome to the InnoGuide podcast. I'm your host, Bob Boudelier. This podcast, my website, and my weekly newsletter focus on helping you discover the secrets of innovation. Since I don't rely on paid ads, I want to thank our customers who subscribe to our AI Fusion Kickstarter program and those who leverage AI Fusion product development and coaching to bring human-centered AI into their organization. You can find us at www.innoguide.net. In this episode, number 72, we'll be sharing 7 Powers by Hamilton Helmer. This book is an interesting read. It has 7 great metrics by which we can assess the business that we might work for or the business we're creating to make sure that we're leveraging one or more of these 7 powers in our business to create moats, to create advantages for us, or to at least recognize where they are. Without further ado, please enjoy this episode. Welcome to the InnoGuide podcast, where we share the works of authors and mentors to guide innovation. Let's get started. As a business coach and advisor, I'm always interested in understanding what gives a business a competitive advantage, and having read 7 Powers, I plan to use this as a lens for each business and mark down which of the 7 powers each company possesses. If I find that one of my client companies doesn't have a strong case for any of these powers, that business might be in trouble because they are likely vulnerable to disruption. Helmer developed the 7 Powers framework after decades of active equity investing and hundreds of consulting engagements. His core argument is that any business lacking at least one of these powers is highly vulnerable to disruption and lacks a viable strategy. Before we dive into the 7 powers, we need to understand the fundamental concept Helmer lays out. Power is defined as the set of conditions creating the potential for persistent differential returns. In simpler terms, power is the ability to earn higher returns on capital. As Helmer himself puts it, power is the core concept of strategy and the holy grail of business, notoriously difficult to reach but well worth your study. Strategy is then defined as a route to continuing power in significant markets. Helmer explains that power requires 2 necessary and sufficient conditions: a benefit and a barrier. A benefit is simply the method that improves your business relative to competitors, and benefits happen practically every day in businesses. However, it's not enough to just have a benefit, because they're plentiful, but barriers, they are not. A barrier is an improvement that not only enhances your business, but also ensures that the resulting gap between you and your competitors persists over time. If you only have a benefit, the excess returns generated can quickly be arbitraged away by the market because competitors can adopt the same benefit. For instance, hiring productive employees is a benefit, but competitors can also hire productive employees. Similarly, selling items in bulk is a benefit because the customer gets a better price per unit, but the barrier to entry for bulk selling is quite low. So the 7 powers we'll cover all consist of both a benefit and a barrier. And these are 1. Scale economies. 2. Network economies. 3. Counter-positioning. 4. Switching costs. 5. Branding. 6. Cornered resource. And 7. Process power. Let's dive into the first one. Chapter 1. Scale economies. Scale economies occur when a business experiences declining per unit costs as its production volume increases. That's fairly obvious. The benefit here is the structural cost advantage by spreading fixed costs over a larger customer base. The barrier is the unattractive payoff or risk-reward dynamic facing new entrants who cannot match the leaders per unit costs. Helmer illustrates this power really nicely in the case of Netflix. Back in the spring of 2003, Helmer invested in Netflix when Blockbuster still dominated the DVD rental industry with its brick-and-mortar stores. Helmer saw the potential for Netflix to shake things up through its impressive mail-order business. Blockbuster faced an uncomfortable dilemma: lose market share or eliminate late fees, which accounted for about half of their income. Helmer's investment hypothesis was grounded in this uncomfortable choice, predicting Blockbuster would drag its feet rather than confront the existential imperatives before them, allowing Netflix to cannibalize their customers. However, the physical DVD business was only temporary, as Netflix knew it would eventually be replaced by digital streaming distribution, ensured by Moore's Law and advances in internet bandwidth. Netflix strategically set up both business units, officially launching their streaming segment in 2007. They understood the imperative: if they didn't make themselves obsolete, someone else would. Initially, Netflix negotiated with content owners for streaming rights, but in 2012, they made a radical choice to create their own content exclusive to their platform, starting with House of Cards. I loved House of Cards. This move was a game changer. If other streaming services wanted to compete with them and differentiate their offering, they would need to spend heavily on creating original content. This industry dynamic gave Netflix a structural cost advantage through scale economies. Consider the cost advantage. If Netflix spent, say, $100 million on content and had 30 million subscribers, they would be spending $3 per subscriber. This spend level would be incredibly difficult for a provider with only 2 million subscribers, as they would be spending $50 per subscriber. As Netflix grew its subscriber base, they could spread these fixed costs over a larger base, creating a flywheel. They could invest more in content than their competitors, which would then attract even more subscribers. A key question is, what prevents a competitor from simply raising a bunch of money and investing in new content to steal market share? Helmer argues that to steal share, a competitor must provide more customer value, either through lower prices or differentiated content. In an established market, this is highly visible to the leader. If a new player tried to enter with lower prices, Netflix could potentially match the price decrease to prevent the new entrant from gaining a significant share, which would ultimately destroy the value for the new entrant. The hallmark of power is a competitive cul-de-sac, meaning entering the market comes with an unattractive payoff. Smaller scale competitors are stuck. If they offer similar content for the same price as Netflix, their profit and loss statement suffers. If they raise prices or offer less content, customers abandon their service. Netflix has to balance its power, aiming for high returns on invested capital. If returns are too high, it encourages competition, driving returns down. If they price too low, they leave money on the table, giving customers a disproportionate share of the value created. It's a crucial balancing act. Beyond fixed costs, scale economies can emerge in other ways. 1. Distributed network density. As density of a distribution network increases, accommodating more customers per area, delivery costs go down due to more economical routes. Old Dominion Freight Line carries less than full truckloads, and they're an example of this. Purchasing economies. Large-scale buyers can negotiate better pricing for inputs. Walmart and Costco are prime examples, leveraging their scale and reach that few other retailers possess. In Netflix's case, the durability of its competitive advantage is obvious, as it's been one of the best-performing stocks since its IPO in 2002. Chapter 2. Network Economies. Transitioning to the second power, we have network economies, also known as network effects. This power occurs when the value of a product to a specific customer is increased by the product's use by others. The benefit here is the higher value provided due to the larger user base, allowing the company to charge higher prices than competitors for the same product. Helmer tells the story of Rick Marini and his professional networking app, BranchOut, launched in 2010. BranchOut was a LinkedIn lookalike tied to Facebook. Marini raised $6 million in Series A funding, was attracting users, hoping to challenge LinkedIn. In a network economy like this, one side of the network growing increases the value for the other side, creating a self-reinforcing upward spiral. Recruiters go where the largest number of active professionals are, and professionals looking for work want their names listed on sites with the most recruiters. Marini was aware he was entering a fiercely competitive realm where the rule was rapidly scale or die. At the time, LinkedIn already had 70 million members. Marini bet he could leverage Facebook's massive user base of 700 million by tying BranchOut into Facebook. Despite people generally wanting to keep their professional and personal lives separate, BranchOut showed early promise, growing quickly from 10,000 users to 500,000, which helped him raise another 18 million. Monthly active users exploded, hitting 14 million by the spring of 2012. However, the growth party ended quickly as churn soon outpaced growth and few users were truly engaged. The site shut down in September 2014. Building network economies is notoriously difficult. When established, the leader has the ability to charge higher prices because of the higher value provided by the larger user base. For example, LinkedIn's Human Resources Solutions Suite, having more LinkedIn users, can charge more than competitors. Similarly, Facebook, now Meta, can charge advertisers more than another social network because they offer targeted ads that deliver a higher return on investment per advertising dollar spent. The barrier for network economies is the unattractive cost-benefit dynamic of gaining share, which can be extremely high. Think about what you'd have to offer someone to use BranchOut instead of LinkedIn. Once LinkedIn is the established user base, there's very little incentive to switch, and the capital required to convert a significant portion of LinkedIn's base is unthinkable. Simply wouldn't be worth a new player entering the market. They would be throwing money away. As a result, network economies often tend to be a winner-take-all industry once the leader has crossed a certain tipping point or scale. Once that tipping point is crossed, other firms are forced to throw in the towel. This is what we saw when Google launched Google Plus in 2011 to compete with Facebook, spending hundreds of millions, yet they still shut it down in 2019. In my view, network economies have brought us some of the best businesses in the world because their competitive moats are so difficult to disrupt, and they are extraordinarily profitable. Meta, Facebook, is a great example. It grew from 1.4 billion global users in 2014 to 3 billion in 2024, with revenue soaring from 12 billion to an astounding 164 billion, a more than 10x increase over 10 years. Their return on invested capital today is around 35%, showcasing the strength of their moat. Interestingly, the spectacular network effect businesses often don't directly offer the product or services users go to the platform for. For example, Airbnb helps travelers find accommodations, but Airbnb doesn't offer accommodations themselves. Uber facilitates rides but doesn't provide the ride-sharing service. These big tech companies benefit from both scale economies and network economies. Meta spends more capital than any competitor, but on a per-user basis, they are likely spending less, getting more bang for their buck. This is because a new incremental user of platforms like Facebook or Airbnb adds practically no incremental cost. Thus, whatever revenue these new users generate practically flows straight to the bottom line. Chapter 3. Counter-positioning. The third power, counter-positioning. This is a tricky one. It's Helmer's favorite form of power because it's so contrarian. Counter-positioning is defined as a newcomer adopting a superior new business model that the incumbent does not mimic due to anticipated damage it would inflict upon their business. This incumbent realizes that they are being disrupted but cannot do anything about it because it would mean disrupting themselves. We can outline counter-positioning using the example of Vanguard and its assault on active equity management. John Bogle started Vanguard in 1975, taking a radical approach of launching an equity mutual fund that simply tracked the market, doing away with active management, stock selection, and trading. It operated at cost, paying all returns back to shareholders. Third innovation was also put in place. Vanguard became a no-load fund, meaning no sales commissions. The fund launched in 1976 but saw less than $20 million in inflows that year. For brokers accustomed to selling actively managed strategies, Vanguard's passive fund was off-putting. A fund with no sales commission was of little interest to them, even if it delivered more value to clients. As Helmer writes, swimming against the riptide of self-interest in the investment business is not for the faint of heart. In other words, nobody's interested in this. Vanguard had a fundamental advantage, though, over active strategy companies. By definition, the average gross return of active funds must equal the market return. Since their expenses are higher than Vanguard's passive funds, the average returns of active strategies will always be lower. So, Vanguard started with no assets in the 70s, but this past year they crossed $9 trillion in assets under management. If a typical active strategy captured a 1% fee on these assets, Vanguard is essentially passing up $90 billion in revenue. Yet they charge practically nothing. The Vanguard S&P 500 ETF V0 has an expense ratio of 0.03%, meaning investors pay only 30 cents for every $1,000 invested to earn higher returns than most peers invested with active managers. Incumbents were too slow to disrupt themselves. They faced the innovator's dilemma. They were successful collecting fees by selling actively managed strategies. Launching a low-cost, passively managed fund was entirely against what their business was built on. It required a new entrant with a superior and entirely different business model to upend the entrenched incumbents. Helmer shares other examples featuring the same outcome: Apple versus Nokia, Amazon versus Borders, and Netflix versus Blockbuster. In all these cases, the incumbent was paralyzed or responded too late. Blockbuster felt its best course was to stay the course rather than completely change what had worked for years. The barrier to entry for Blockbuster was that they didn't want to divert capital to a new uncertain project, likely outside their circle of competence. Netflix, conversely, had nothing to lose in betting on streaming. Had Blockbuster pursued the same strategy, they had everything to lose, including their peak of over 9,000 stores. They were better off milking the existing business. Visibility is another issue for incumbents. Even when seeing their business decline, they might not have visibility on whether a newcomer's investments will pay off. Incumbents are also biased toward the status quo and tend to belittle the new way of doing things, often underestimating its potential. Ned Johnson of Fidelity, facing the low-cost passive fund, once remarked, "Why would anyone settle for average returns?" This negative bias can lead to decisions not to enter a new market. Finally, job security plays a role. Once a company is large and established, managers often prioritize keeping their jobs and providing for their families over taking risks. If you were making millions at Blockbuster, why risk failure and losing your job by totally changing the business model? Economists call this an agency problem, where the agent's action conflict with the organization they represent. Helmer believes counterpositioning presents one of the toughest management challenges. He notes that Nokia, the smartphone leader, when he started teaching at Stanford in 2008, had vanished by 2014. The frustration of the incumbent is captured in Nokia CEO Stephen Elop's 2011 Burning Platform memo. Elop wrote that Nokia missed big trends, lost time, and found themselves years behind, noting that 2 years after Android entered the scene, they had taken Nokia's leadership position in smartphone volumes. Helmer refers to the repeating pattern of a disrupted incumbent as the 5 stages of counterpositioning: denial, ridicule, fear, anger, and capitulation. Helmer believes Elop was in the anger phase in that 2011 memo. The summary for the challenger is rapid market share gains and strong profitability, or promise thereof. The incumbent experiences market share losses, an ability to counter the entrant's moves, and eventual management shakeups and capitulation, often occurring too late. Chapter 4. Switching costs. Next up, the fourth power, switching costs. These are defined as the value loss a customer expects to incur if they switch to an alternate supplier for additional purchases. The benefit of this power is that the power holders can charge higher prices than the competitors for equivalent products or services. We've all seen this in a cable bill that locks you in at a low cost for the first year, and the second year is higher, but you're in a contract. Same thing happened in cell phones for many, many years. Helmer uses the case study of SAP, the leading supplier of enterprise resource planning, ERP software. ERP software centralizes business functions like finance, HR, supply chain management, and sales. Despite its success, SAP is not a poster child for customer satisfaction. One study found that 43% of customers were unhappy with SAP response times, yet almost 90% of them still expect to continue paying SAP in the near future. The simple reason? High switching costs. Once ERP is integrated, employees are trained, relationships are established with service teams, and customization investments have been made. Switching to a new ERP system requires immense time and effort, researching options, transferring all data, retraining staff, forming new relationships, and risking that the transition goes wrong. Even a significantly better ERP solution would be a tough sell due to these high switching costs. Once hooked, customers enable SAP to reap rewards from annual maintenance upgrades and add-on services as well as consulting. It's important to note that switching costs are a non-exclusive power type. This means that competitors such as IBM and Oracle can also enjoy these benefits of a high customer retention rate and high switching costs once they acquire a customer. As the market matured and the value of an acquired customer became transparent to all players, competition to grab new customers intensified, eventually arbitraging away the value of those new customer acquisitions. This forced SAP to focus on generating more revenue from their existing customers. They added a host of add-on products, often through acquisitions, integrating these new products into their existing suite. As customers became more entrenched in SAP's ecosystem, the switching costs rose even further over time. For competitors to challenge a powerholder like SAP, they must compensate customers for the existing switching costs. This could involve offering more value at a similar price or a similar amount of value at a much lower price that exceeds the cost of switching. So Helmer breaks down switching costs into three broad categories. 1. Financial, the direct monetary cost of switching. 2. Procedural, murkier, but the real costs are stemming from the loss of familiarity, risk, and uncertainty associated with adopting a new product. And relational, costs resulting from breaking emotional bonds established through product use and interactions with service teams or other users. Often customers establish close, beneficial relationships with the provider's sales team and service teams. Chapter 5. Branding. The fifth power is branding, which Helmer defines as the durable attrition of higher value to an objectively identical offering that arises from historical information about the seller. Boy, that's a mouthful. The benefit is the ability to charge a premium. Investors like Buffett and Munger have made fortunes recognizing the power of great brands, such as See's Candy, Coca-Cola, and Apple. Owning a brand that consumers love is the gift that keeps on giving. The case study Helmer uses is Tiffany. In 2015, Good Morning America compared a diamond ring bought at Tiffany's for $16,600 with a similar size and cut ring bought at Costco for $6,600. A reputable appraiser assessed the Costco ring at $8,000 and the Tiffany ring at $10,500 at a non-brand name retailer. Despite the objectively similar value, Tiffany's is able to command a hefty premium. The appraiser explained that Tiffany's has built a reputation based on trust and quality. When purchasing from Tiffany, customers don't have to think twice. They know exactly what they're getting and they're willing to pay for that peace of mind. One customer review explained that their priority was buying from the best of the best without doubting the quality or certification, and they were happy to pay up. For some, the rationale even extends to the impression the ring will leave on grandchildren who eventually inherit it. Tiffany was founded in 1837 and has cultivated its reputation for high-quality jewelry over a long, arduous journey. They gained world recognition by winning awards for silver craftsmanship at the Paris World's Fair in 1867 and continued winning subsequent awards. The brand has become a standard for wealth and luxury, carefully curating its image over its long history. This curation is evident even on its signature blue box. The packaging copy states that the blue box epitomizes Tiffany's great heritage of elegance, exclusivity, and flawless craftsmanship. Heritage implies a long positive history. Elegance designates a consistent aesthetic design. Exclusivity hints that the product is only attainable by those willing to pay for the best, suggesting no competitor can provide this specific craftsmanship. And flawless assures the customer that the company has repeatedly created perfect products, eliminating quality uncertainty. The power of this brand shows up in the margin profile. Competitor Blue Nile has razor-thin margins, 2 to 3%, while Tiffany's margins are around 12%. Branding is an asset that communicates information and evokes positive emotions, increasing the customer's willingness to pay. And since we buy with emotion, of course, that's important. The brand value is distinct from the objective value of the good. For example, a generic cola might be indistinguishable from Coca-Cola in a blind taste test, yet, after the reveal, the customer remains willing to pay for the Coca-Cola brand. Uncertainty reduction is a key component. The customer attains peace of mind knowing the branded product will be just as expected every time. The barrier to entry is strong because the best brands are created only over a lengthy period of reinforcing actions. Competing with a brand like Tiffany built over 200 years is a difficult undertaking with no guarantee of success. Some suggest thinking of a company as either making deposits or withdrawals in their brand's equity value, or treating the brand as an investment in physical infrastructure on the balance sheet. Just as a fleet of vehicles depreciates over time, requiring an investment, deposits, a brand requires continuous investment, deposits. Tiffany's has been making deposits into its brand account for decades, rarely if ever making withdrawals, so their brand strengthens with time. Companies make withdrawals or damage their brand equity in several ways. 1. Going down market. Selling cheaper items at higher volumes reduces the brand's perceived exclusivity. If Ferrari started selling $50,000 cars, it might boost short-term profits, but will likely hurt long-term brand value. Or they can reduce quality. Nike invests in its brand through deals with top athletes. If Nike reduces shoe quality over time, it boosts short-term profits, but sacrifices the perceived value of the brand in the long term. Brands also face challenges like counterfeiting. Since power often stems from a label, counterfeits try to free ride. Luxury brands constantly monitor this threat, exemplified by Tiffany suing Costco in 2013 for implying that they sold Tiffany jewelry. Tiffany explicitly stated in a press release that it has never sold, nor would ever sell its fine jewelry through an off-price warehouse retailer like Costco. Another consideration is changing consumer preferences. Nintendo, for example, built a brand for family-friendly games, but the gaming demographic evolved toward adults demanding more mature games. Apple is a fascinating brand study. They prioritize simplicity and creativity, fostering an emotional bond. Apple has become a status symbol and a cultural icon. In college, owning a Mac meant you fit in and weren't the lame kid with the boxy, slow computer. They provide a consistent customer experience across all touchpoints: the iPhone UI, product unboxing, and the consistent feel of their devices: iPad, AirPods, Apple Watch. Great brands create a positive emotion. People feel good buying an iPhone, even if they pay $2,000, and often return to buy the next one, despite past negative experiences. Despite Android being the global market share leader, Apple captures the majority of the profits in the smartphone market because they offer unique value that others can't easily replicate. Chapter 6. Cornered Resource. Transitioning to the sixth power, we have cornered resource. A cornered resource is defined as preferential access at attractive terms to a coveted asset that can independently enhance value. Another mouthful. Essentially, the company has access to a resource that others simply can't obtain. Cornered resources can take various forms. Preferential access to a valuable patent, like a blockbuster drug. Ownership of a required input, like a cement producer owning a nearby limestone quarry. Or a cost-saving production or manufacturing approach. Helmer illustrates this power with the case study of Pixar. Fun fact, most of Steve Jobs' wealth actually came from the sale of Pixar to Disney in 2006, not Apple. Disney bought Pixar for $7.6 billion, netting Jobs $4.4 billion in Disney stock. In 1995, Pixar made a moonshot bet with Toy Story, the first computer-animated feature film. With a production budget of only $30 million, it grossed over $350 million worldwide. Pixar went public and continued releasing successful films like A Bug's Life and Toy Story 2. Their commercial success was impressive. They consistently posted gross profit margins over 50%, while other non-Pixar movies had margins of around 15%. This sustained above-average performance was coming from a company that in 1990 had fewer than 50 employees and frequently teetered on ruin, often sustained only by Steve Jobs. Helmer claims that there's no precedent for this sort of sustained success in the movie business, especially spanning multiple directors and teams. Movies are generally collaborative, creative endeavors, usually immune to the predictable triumphs indicative of power. To understand Pixar's competitive advantage, Helmer details its origins. In 1986, a small company was spun out of Lucasfilm to Steve Jobs for $5 million and renamed the Pixar Computer Group. Pixar had three extraordinary people leading the charge, forming a brain trust. Number 1, Steve Jobs, the business and financial fanatic, though struggling with Next Computer at the time. Number 2, John Lasseter, an animation genius, previously fired from Disney for his tireless advocacy for CGI and animation. And 3, Ed Catmull, the computer scientist with the intelligence and ability to manage high-octane creatives. Helmer asserts that without any of these three, the Pixar story would have been an unhappy ending. For Pixar, the cornered resource was its creative talent and culture, specifically its brain trust and storytelling capability. Although Pixar's key talent was highly sought after, they demonstrated an unusual amount of loyalty. When Disney tried to recruit Lasseter back after he won an Academy Award for a Pixar short, Lasseter famously stated, "I can go to Disney and be a director, or I can stay here and make history." The barrier to competition in Pixar's case was largely personal choice. Since poaching employees wasn't an option, Disney eventually acquired Pixar to gain control of this valuable talent. This example reminds me a bit of SpaceX. SpaceX attracts some of the most talented aerospace engineers in the industry. An engineer could get a safe job at NASA, but if they're interested in leaving their mark on the world, SpaceX, which prioritizes innovation and has a clear mission of making life multiplanetary, is much more appealing. SpaceX's cornered resource is bringing in top talent combined with a culture of innovation. This enables vertical integration, which provides a cost advantage, faster iteration, and tighter feedback loops. SpaceX also has a cornered resource in proprietary IP. They have been the only aerospace company to consistently reuse rockets for commercial use. This IP, surrounding custom parts and in-house manufacturing, dramatically reduces launching costs, further strengthening their cost advantage over competitors. Finally, Chapter 7, Process Power. This brings us to the final power. Helmer defines process power as embedded company organization and activity sets that enable lower costs and/or superior products which can be matched only by an extended commitment. Again, a mouthful. Helmer has found that process power is quite rare in modern businesses. The definitive case study is Toyota, a Japanese car manufacturer. Around 1969, when Helmer graduated college, he and a friend acquired the Toyota dealership rights in northern New England. This was a risky move, as Toyota held only 0.1% market share in the U.S. compared to General Motors at 48%. But his friend saw Toyota as an extraordinary up-and-comer because of the sheer quality of their vehicles, a stark contrast to Detroit's world-leading firms. Toyota had spent nearly 2 decades relentlessly honing a competitive asset known as the Toyota Production System, TPS. In 1950, Ijai Toyota studied Ford's massive integrated factory in Michigan. While he had been impressed by Ford in 1929, his reaction in 1950 was the opposite. His observations were that Ford maintained deep inventories to smooth out production irregularities, which Ijai saw as a total waste. Toyota developed TPS based on deep roots in quality and efficiency, resulting in more durable and higher quality cars than their American counterparts. Many have tried to emulate TPS, but few have succeeded, due to Toyota's deeply ingrained culture, which requires alignment from the top leadership all the way down to factory workers. TPS is far more than just lean manufacturing principles or assembly lines. It's a highly refined set of processes developed over decades that reduce waste, improves quality, and empowers frontline workers to fix problems in real time. The results were staggering. Toyota went from 0.1% market share in the 1960s to over 14% in 2014, while General Motors' share fell from over 50% to just over 17% in the U.S. during the same period. General Motors recognized TPS's effectiveness and even partnered with Toyota in 1984, allowing them to utilize Toyota's production techniques at a factory in Fremont, California. GM had high hopes of transferring these techniques. Fremont workers were sent to Japan for training, but GM was unable to effectively replicate Toyota's results in their own facilities. The challenge is that TPS is not quite so simple as it appears. On the surface, it involves straightforward procedures like Kaizen, continuous improvement, and Kanban, inventory control. Despite thousands of businesses touring Toyota's facilities, few have successfully replicated the results because of the complex systems supporting the plants that aren't visible during a tour. Ernie Schaefer, a GM plant manager, noted how puzzled they were that Toyota allowed them to walk through the plant and ask questions. He concluded that Toyota knew we were asking all the wrong questions. Their questions were focused on the floor and the assembly plant, but that wasn't the real issue. The issue was how to support that system with all the other organizational functions that must take place. Toyota's level of execution far exceeded its competitors and was incredibly difficult to replicate. Since Toyota's manufacturing process was difficult to replicate, it created a durable barrier to entry, preventing competitors from producing similar quality vehicles at a low price. Process power ties in well with the concept of execution. Sometimes why a business does well is simple but not easy. Using a sports analogy, it's simple for a basketball player to practice fundamentals, get strength workouts, and shoot hundreds of shots every morning, but it's not easy. Costco provides another great example. All retailers can see that Costco runs a ruthlessly efficient operation. Although some aspects of their process may be difficult to see, their strategy is mostly visible. Yet, practically nobody has replicated it. Costco is disciplined in refining internal operations, promoting a positive culture, and enhancing customer experience. They resist the short-term pressures to take the path of least resistance. For instance, Costco resists the temptation to raise prices slightly to bump up margins. Costco maintains a gross margin of 12%, while Walmart is 25%. The strength of process power is that it cannot be built overnight. Even if a competitor matched Costco's prices, launched a private label brand like Kirkland, used a membership model, and built a similar warehouse format, they couldn't replicate the outcome without decades of process refinement, building high levels of trust with suppliers, training employees, and instilling the necessary culture. The competitive advantage in process power is much more than what meets the eye. Chapter 8. Leveraging the Framework for Business Building. The 7 Powers Framework is not just a tool for investors to judge companies. It's a critical guide for entrepreneurs and business owners aiming to build enduring value and create companies that earn high returns on capital. The second part of Helmer's book focuses on the strategy dynamics, discussing how the 7 powers are developed. The first critical insight Helmer shares is that all powers start with invention. Helmer writes, "The adage of, 'me too won't do,' guides the creation of power. Innovation is key because great businesses are built by visionaries like Steve Jobs or Elon Musk, who do something entirely new. They are not merely looking at competitors and saying, 'How can I do things just a little bit better?' They are totally revolutionizing an industry." We can revisit the Netflix case to understand this genius. When Helmer invested in Netflix in 2003, his hypothesis had 2 legs. First, Netflix's DVD rental business already had power. It was counterpositioned against Blockbuster and had process power and scale economies relative to other DVD by mail services. The second leg, though, was the belief that investors were mispricing or undervaluing that power. Netflix's dramatic demise of Blockbuster proved the potency of counterpositioning. But Reed Hastings knew the DVD by mail business was temporary. He saw the tectonic shift towards streaming years in advance, which is why the company was named Netflix and not DVD by mail. Netflix was ready to capitalize once technology enabled global streaming. However, the early streaming business had no source of power. Netflix faced Michael Porter's uncomfortable truth: operational excellence is not a strategy. They came to realize that content was the core value proposition and accounted for the bulk of their cost structure. Since content holders could charge based on usage, this prevented economies of scale from taking place, putting all streamers on an even footing regardless of size. The route to power for Netflix required invention. Ted Sarandos pursued exclusive content, which totally changed the game. The price of an exclusive was fixed, and suddenly, Netflix's substantial scale advantage mattered. It was crucial for Netflix to own the content itself. Once Netflix had the capital to create its own content, the bargaining position shifted. Content owners needed Netflix more than Netflix needed them. The success is obvious, with shares up over 1,000 times since the 2002 IPO, even against behemoths like Amazon and Disney. The path to this power was unknown and unknowable, even to management, until they successfully executed this invention. For the entrepreneur, building value means finding this route to power. You must consider the external environment, threats and opportunity, leverage your company's unique resources, and use those resources to invent new solutions. Furthermore, success requires scale. Having power in a small market doesn't deliver much value to shareholders. Helmer observes that the ascent of great companies is not linear, but more like a step function. There are critical moments where decisions are made that inexorably shape the company's future trajectory. Once a company, whether Netflix or Facebook, crosses a tipping point, it becomes incredibly difficult to disrupt. The insight This insight is valuable for both investors and operators. The biggest takeaway for business owners is recognizing the fundamental difference between benefits and barriers. Every measure to improve your product or reduce costs offers a benefit. But to achieve durable success, to really move the needle in value and ensure that success persists, you must create something that others have difficulty accessing or replicating. As Helmer succinctly states, benefits are common, but true barriers are rare. Understanding this difference is a game changer for entrepreneurs and operators looking to build lasting value. If you focus simply on having a good product, a benefit, without an entrenched barrier, you are highly vulnerable to disruption. The 7 Powers framework provides the structure to identify and cultivate those rare durable barriers that are the true source of business value. I hope this framework helps you better evaluate what gives business an edge, and more importantly, whether that edge is durable. As you build out applications, leveraging AI, and as you look at all the applications that are built out around you, consider whether they have a durable edge before you make an investment in building around those tools. Thanks so much for your time and attention today, and I look forward to seeing you again soon. Remember that our website is innoguide.net, where I have many resources for innovators and people who want to build medical products, with or without embedded AI. And for those who want to learn AI from someone who's worked in medtech for 30 years and has been using large language models since they emerged in 2022. I want to thank Steve McIntyre for producing this, and I want to thank you for joining. I look forward to seeing you next time. That's a wrap.